Senator Orrin Hatch warns it has the power to destroy the retirement savings of millions of Americans. Famed economist Leonard Berman of Syracuse University is warning the U.S. Senate of disastrous consequences for ourselves and the rest of the world. Goldman Sachs, Bank of America, Morgan Stanley, Royal Bank of Scotland, J.P. Morgan, and Oppenheimer funds are all warning that it could bankrupt millions of investors. Congressman Ron Paul says simply, "This country will be ruined." These and many other authorities are talking about the greatest financial bubble in human history, a bubble that is now more than 8 times larger than all the stock exchanges in the entire U.S. combined. A bubble so massive it is 4 times larger than both the dot-com bubble of the 1990s and the housing bubble of the 2000s combined. Now, that bubble has begun to burst. As it implodes, it will launch interest rates into the stratosphere, crush the feeble U.S. economy, destroy major U.S. banks and insurance companies, drive your cost of living through the roof, threaten your standard of living and financial security, and push the U.S. government to the very brink of financial collapse. But the best defense is a strong offense. And this crisis will also create windfall profit opportunities for a select group of investors who make the right moves now. In this program, we will reveal the startling facts about this great bubble that the pop media won't tell you, including alarming evidence that it has already begun to burst, plus the steps you need to take immediately to protect yourself and profit. Your profits could be enormous. In just the last few weeks, a few very tiny minuscule fissures in this massive bubble have opened, and one liquid, easy-to-buy investment has already risen 75% in just 38 days. Another surged 141% in just 21 days, and a third soared 156% in value in a mere 22 days, enough to turn a $10,000 investment into $25,600 in less than 1 month. As this crash accelerates in the days ahead, your profits could be far greater. In fact, before this program has ended, we will name 2 often overlooked investments that, due to this crisis, now have the potential to turn a $25,000 grub stake into a $148,500 windfall. Our host is Weiss research analyst Thomas Essay, a professional trader with more than 10 years of experience in foreign and domestic equities, commodities, currencies, and bonds. Mr. Essay began his career as a trader on the floor of the New York Stock Exchange for Merrill Lynch, where he regularly traded multi-million-dollar orders for some of the largest mutual and hedge funds in the world. In early 2005, Mr. Essay joined a global hedge fund where he invested in precious metals, agricultural commodities, energy, and natural resource-related equities, placing initial long positions in gold below $500 per ounce and silver below $7 per ounce. More recently, Dr. Martin D. Weiss, founder and chairman of Weiss Research, became so impressed with Mr. Essay's unique approach to wealth building that he picked Tom to call the shots with $1 million of his own personal money. Ladies and gentlemen, Mr. Thomas Essay.
Hi, I'm Tom Essay, and welcome to the deadliest bubble in 237 years. During this special presentation, I will reveal how I'm investing the extra $25,000 Dr. Weiss has entrusted to me, why I believe those small investments could turn his $25,000 into at least $87,500 in the coming year, and why, in the best case scenario, it could turn his $25,000 into a whopping $148,500 in the coming year, and how you can invest right along with us as we go for an enormous payday in 2013 and beyond. If there's anyone who knows how to capitalize on bursting bubbles, it's our firm, Weiss Research. All of us are extremely proud that in the late 1990s, we were one of the first financial firms in the world to warn investors that the tech stock bubble was about to burst. Investors who heeded that warning didn't have to lose a penny when the NASDAQ index crashed 78%, and many tech darlings fell to zero. Equally important, you could have used our warnings to buy things that soar when stocks sink. An ordinary leveraged investment vehicle designed to soar when NASDAQ stocks sink rose 350% in value between March and October of 2000 alone. A second jumped 395%, and a third soared 600%, enough to turn every $10,000 into $70,000. We're also proud that in 2005 we became one of the first to sound the alarm before the housing bust. Mike Larson, who will join me in a moment, even named the companies and stocks that would be hit hardest well in advance. Once again, investors who acted on that warning didn't have to lose a red cent when the S&P plunged 56% in the most painful recession since the Great Depression. And once again, anyone who acted on that warning could have earned windfall profits. One simple investment anyone can buy in an ordinary brokerage account generated a 92% gain. Another jumped 107%, more than a double, as the housing bust unfolded. And still another soared 225% in value between 2007 and 2009, enough to multiply your money more than 3 times over. For nearly a year now, I've been sounding the alarm again, not for the bursting of a bubble in the tech sector or the housing sector, but in a market that is many times larger than all the stock exchanges in the United States combined. And as before, I am absolutely convinced that if you heed this warning, you will not only sidestep the costliest economic and financial crisis any of us have ever seen, you will also have the opportunity to reap windfall profits, even potentially multiply your money many times over. In fact, that is precisely why I recently asked Dr. Weiss to let me invest an additional $25,000 on top of the $1 million he has already entrusted to me, to stake a claim to truly enormous profit potential as this giant bubble begins to burst. As I said earlier, even if the coming crash is far less severe than I expect it will be, the bursting of this great bubble could generate a 250% gain, turning Dr. Weiss's $25,000 into as much as $87,500. And if my best case scenario is fully realized, Dr. Weiss's $25,000 could, over time, be worth as much as $148,500. And unless I miss my guess, this will begin to happen sooner rather than later. And in just a few minutes, I'm going to name these investments for you so you can grab the same profit potential we have. Look, it's no secret that we, all of us, are sitting on a ticking time bomb. I'm talking, of course, about the most colossal mountain of debt in world history, a bubble of such monumental proportions that it dwarfs the tech stock bubble of the 1990s and the housing stock bubble of the 2000s combined. The thing about bubbles is they all burst without exception, and the bigger they are, the harder they fall, the more damage they inflict on the economy and on unwary investors. But for sophisticated investors, bubbles create enormous opportunities, and the bigger the bubble, the more money it could make you. And as we'll see in a moment, this bubble, the bubble in the U.S. debt markets, is the granddaddy of them all. Now, debt is created in the bond market. That's where the government goes to borrow money. So do states and local governments. Companies too. Borrowers sell bonds or notes or bills that guarantee investors a certain rate of interest or yield over time. Since the turn of the century, the U.S. bond market has simply exploded in size, adding $20.7 trillion in new debt. But now, despite massive new initiatives by the U.S. Federal Reserve, the meteoric rise in prices that characterized the debt market since the turn of the century has sputtered, stalled, and is now dead in its tracks. Millions of investors all over the world, including many of the world's richest central banks, have started to stampede for the bond market's exit. And now we're beginning to see the first cracks appearing in this massive bubble. This chart of the PIMCO Total Return Bond Fund is a perfect picture of the bubble in the bond market, and also the beginning of the crash. On the left side of the chart, you can see the bubble in the bond market being inflated. On the right-hand side, you can see how prices just plunged well below their support levels. And just look at this chart of the iShares Municipal Bond ETF. It just fell off the proverbial cliff, giving back every penny it had gained since last July. But this crash has barely begun. The last few Treasury auctions showed that bidding from foreign central banks is plunging to the lowest level in years. In addition, U.S. investors are starting to turn bearish on Treasuries. A recent report from a top industry watchdog showed that nearly 20% of all Treasury investors have started to cut back their holdings. Even Fitch, the normally conservative ratings firm, is warning that a massive bubble has been created in the bond market. Now, this is huge. Bubbles are like an enormous Ponzi scheme. They collapse when the money stops flowing in. The moment that happens, it's over. And it's beginning to happen right now. As this bubble, the greatest bubble mankind has ever seen, implodes, the consequences will be devastating for millions of unprepared investors, just like the tech bubble was and just like the housing bubble was. The most vulnerable are those who can least afford to suffer losses. Seniors who are approaching or in retirement, who have shifted large amounts of their money into fixed income investments. Your tax-free municipal bonds could tank. Your annuities and other insurance policies could turn to dust. Your money invested in bank and insurance company stocks could vanish before your very eyes. Mike Larson, editor of the Safe Money Report, has earned international acclaim as the only analyst to not only forecast the historic housing bust and Great Recession of 2008-2009, but also to name each one of the major companies and stocks that were hit hardest. Let's go to him now. And Mike, please explain why a crash in the bond market is so critical.
Hi, Tom. And you're right. This is a big deal because the bond market is huge. To understand how huge this is, let's first add up the value of all the stocks of all the listed companies on all the exchanges in the United States. That's $25.8 trillion, according to the Fed. Plus, to make sure we're not missing anything, let's also add up the value of stock futures, stock options, and other stock instruments. According to the U.S. Comptroller of the Currency, that's another $2 trillion. Total equities in America, about $27.8 trillion. Now let's do the same thing for bonds and other debt instruments. The total outstanding debt right now is $55.3 trillion, and that's already twice as big as all the stock markets combined. But it's just the tip of the iceberg, because in addition, U.S. banks hold a whopping $179 trillion in derivatives that are based on bonds and the like. Grand total of bonds and debt instruments, $234.3 trillion. That's 8.4 times the size of all U.S. stock markets combined. The plain truth is that today's debt bubble dwarfs the bubble in tech stocks and the bubble in housing stocks combined. At the peak of the tech stock bubble in 2000, the entire NASDAQ index was worth $5 trillion. And at the peak of the housing bubble in 2007, the entire real estate and financial sectors were worth $8 trillion. But today's market in actual debt instruments is $55.3 trillion. That's 4 times larger than the tech stock bubble and the housing bubble combined.
So the bursting of this enormous debt and bond bubble means that anybody who owns bonds, bond funds, or derivatives tied to bonds is about to suffer huge losses. And that includes everyday investors, banks, insurance companies, pension funds, and not to mention every government in the world that Washington owes money to. More to the point, if you own any kind of bond, bill, or note, you will suffer huge losses. If you own stock in a company that holds bonds or debt derivatives, you could suffer huge losses there as well. If your pension fund or retirement plan invests in bonds, it could suffer huge losses. And there's another reason why this bubble impacts almost every investment and business in the world. When bond prices fall, interest rates rise. Higher interest rates would sabotage the housing market, undermine corporate profits, drive your cost of living through the roof, and virtually snuff out any whiff of economic growth that remains in the air. So the big lesson here is that when bond prices collapse, interest rates go through the roof, And if bonds fall in half, their interest rates double. And there's more. Look, when stocks fall, they fall. Investors lose money. When bond prices collapse, like they're beginning to now, investors also lose money. Plus, when bonds crash, interest rates shoot the moon, which would be a death sentence for an economy on life support like ours is now. Worse, foreigners own an enormous amount of U.S. debt. So this time around, the U.S. dollar will also get clobbered. Your buying power could plunge. Your cost of living could soar. When the bond market crash accelerates, millions of people will be pushed to the brink of bankruptcy and beyond. Let's go to Larry Adelson, reporting from Los Angeles today. Larry has the distinction of being one of the very first analysts to forecast a massive new bull market in gold and natural resources all the way back in the year 2000, when gold was selling for under $300 per ounce. Larry, you're Weiss Research's inflation and bullion specialist. Please explain why a crash in the bond market pretty much guarantees our cost of living will explode.
Oh, sure, Tom. It's actually pretty simple. It's because you can't buy U.S. bonds without using the U.S. dollar, U.S. money. Before a foreign investor can buy a treasury bond, a municipal bond, or a corporate bond in the U.S. bond market, he must first exchange his yuan, his yen, or his euros for U.S. dollars. So as the bond market bubble was growing, demand for U.S. dollars was also growing. But when foreigners sell U.S. bonds, the opposite happens. They have to sell U.S. dollars too. They cash in their bonds for U.S. dollars and then exchange those dollars back into their home currencies. That drives the dollar down and the price we pay for just about everything straight up.
Well, and in turn, the falling dollar causes more declines in bond prices. Explain how that happens, please.
Well, sure. Investors are not stupid. They know the low inflation numbers Washington reports are pure baloney, 100% baloney. And they're right. John Williams, an expert economist who tracks inflation the way Washington used to back in 1980 before they started manipulating the numbers, reports that the true inflation rate today is now well over 10%. Every year, that means the value, the buying power of our money is falling by 10 freaking percent. At that rate, prices double every 7 years. And worse, it means that buying a bond guarantees you a loss in real terms. True inflation is now running more than 3 times what the 30-year Treasury is paying, 6 times more than what the 10-year Treasury is paying, and a whopping 14 times what the 5-year Treasury is paying. And get this, 40 times more than what the 2-year Treasury pays. So the same is also true with municipal and corporate bonds, and even most junk bonds. The riskiest bonds on the market are even paying far less than the true inflation rate. When adjusted for inflation, the ridiculously low rates the bond market is paying now virtually guarantees you're going to get poorer very quickly. And that means as true inflation continues to rise, the likelihood of a massive bond crash also rises.
Exactly. It's like a downward death spiral. Falling demand for bonds crushes the dollar, and the falling dollar cuts bond demand and prices even more. Ultimately, you have a collapse that crushes investors, companies, and potentially the entire U.S. economy. And the ironic thing is that the Fed did it, the U.S. Federal Reserve. Larry, your home is in Bangkok, Thailand. You have a unique perspective outside of the United States. How have the Fed's actions been seen by foreign investors?
Well, the folks at the Fed have definitely sent a clear message to investors all over the world. They have proclaimed that U.S. Treasuries are the one investment being directly supported, even jacked up in value, by the largest, most powerful, richest central bank on the entire planet. So that did indeed attract a lot of investors to Treasuries like bees to honey. Plus, whenever there's been a crisis anywhere in the world, billions more dollars flooded directly into Treasury bonds, especially over the past 3 years or so, as the European Union was pushed to the brink of collapse. Until now, this explosion in bond prices delivered massive profits to bond investors. But it's also a giant bubble that, when reversed, can deliver far greater profits in a much shorter period of time to savvy investors.
Yes, but so far we've been talking mostly about U.S. government treasuries, which are widely perceived to be the most stable part of the bond market. So if they're now threatened with collapse, you can bet your bottom dollar that the other end of the market, the riskiest bonds issued by the riskiest companies in America, junk bonds that are rated BB or lower, are courting an absolute disaster. When you buy junk bonds, you're taking a higher chance that the company will default on the interest or even the principal. But investors buy them anyway because they pay a much higher yield than high-quality bonds. It's higher risk, higher return. As a result of the ocean of money pouring into junk, the junk bond bubble is matching or even exceeding the peaks that marked the end of prior bubbles. Now consider these facts. Junk bond sales for the year through November totaled $353 billion, according to Bloomberg. That's more than double the $144 billion per year average we saw in 2005 through 2007, right before the previous bubble imploded. Separate figures from Thomson Reuters show junk bond issuance up a whopping 36% year over year through October. More junk bonds were sold in September of last year than all of 2008. More broadly, investors bought $6.6 billion of bond funds, including junk, in the week of October 24th, then another $2.6 billion a week later. In just 3 weeks of November, another $18.6 billion. As a result, junk bond yields plunged to 6.14% last September, the lowest level in history. Mike, what are your thoughts on this?
Well, look, none of this should come as a surprise to anybody. I mean, we all know the Fed under Alan Greenspan and now Ben Bernanke is a serial bubble blower. It has repeatedly created bubble after bubble with reckless, easy money policies. The only thing that changes is the asset class. First it was the dot-coms, then it was housing, and now it's bonds. And we've seen this kind of mania blow up in our faces not just once, but twice in the past 12 years. And investors have made the same mistakes each time. Just as they did during the tech bubble, they've made high-stakes, low-intelligence investments in lousy companies. And just like they did during the housing bubble, they're buying the same kinds of crappy alphabet soup investment products that caused hundreds of billions of dollars in losses only a few short years ago. And we're not the only ones concerned, by the way. Sheila Bair, the former head of the FDIC, is also warning about a massive bubble in risky bonds. In a column in Fortune earlier this year, she wrote, quote, "As we saw in the years leading up to the subprime crisis, yield-hungry investors are taking on more and more risk. Pension managers are investing in hedge funds, and gullible investors are buying up junk bonds."
Okay, so let's recap. We have established that the bond market is an enormous bubble, and there's no doubt about that. We have shown that it is many times larger than any bubble any of us have ever seen, and there's no doubt about that either. And we know that all bubbles burst, zero exceptions. So here's the $64 million question. Why now? Why is this great bursting of the bond market bubble happening now? The reason is that the Fed has fired all its bullets, and now it is out of ammo. It has lowered interest rates all it can. They can't go any lower than zero. That means there's only one way for interest rates to go now, and that's up. Plus, the Fed has printed more than $2.8 trillion since 2007 and used most of that money to buy bonds. But now they've printed so much money, more printing no longer has any impact on bond prices or the price of other risky assets. Last month, the Fed announced QE Infinity +1, saying it's going to print $45 billion additional dollars every month and use them to buy long-term treasuries. That's in addition to the $40 billion per month in purchases of mortgage-backed securities, another type of bond. Combined, those moves are enough to expand the Fed's balance sheet from about $2.9 trillion now to as much as $4 trillion in the future. Plus, as if to add insult to injury, the Fed also said it will keep money exceptionally easy well into 2015, even allowing inflation to run half a percentage point above its old 2% target, as long as unemployment stays above 6.5%. These were the biggest, most beyond-the-pale moves we have ever seen from the Fed. But what happened in response? Outright selling of the bond market. Several bond market ETFs, like the two we looked at the beginning of this program, plunged below critical support levels while yields spiked. So not only did the Fed's announcement of more money printing and more bond buying utterly fail to drive bond prices higher, it actually caused them to fall. If that isn't a clear indication that this bubble is starting to burst, I don't know what is. Look, this was inevitable when you think about it. From the first moment in 2007, when the Fed began inflating this bubble, it was carved in stone. Every bubble bursts. In the euphoria that goes along with soaring bond prices, investors have ignored the fundamental rules of investing. They have failed to balance risk and reward, and they are buying debt that everyone knows cannot be repaid. Worse, they are being paid next to nothing for their trouble. Worst of all, they are being paid in dollars that are being gutted of their value. The emperor has no clothes. The bond market is a house of cards, and now the first cards have already begun to fall. There's only one way interest rates can go now, and that's higher. The only questions that remain are, how big will this crisis be? How will it impact the economy and investment markets? And what should you be doing right now to protect your wealth and profit? Let's look at the dangers first. Skyrocketing interest rates will make it prohibitively expensive, possibly even impossible, for our governments, companies, and consumers to borrow money the way they have, and worse, impossible even to make good on the interest they owe on current debts. Even the Congressional Budget Office has warned that the interest in government pays on short-term debt could jump by a factor of 25 times. And the CBO also estimates that Washington's total interest payments will nearly quadruple. Plus, higher interest rates will be pure poison for thousands of U.S. companies. For insurance companies that are loaded with long-term corporate and government bonds, for banks that are counting on low interest rates to raise funds for next to nothing, for utilities that continually borrow huge amounts of money to finance massive investments in power plants, for home builders who need cheap financing to attract buyers, and most importantly, for 80 million baby boomers who are now retired or approaching retirement and have the lion's share of their money invested in supposedly safe bonds and bond funds. Plus, never forget, a crash in bond prices means a crash in the U.S. dollar. So in addition to watching your fixed income investments go up in smoke as bonds crash, and in addition to suddenly having to pay much more interest on every credit card you have and every new loan you need, you're also going to see inflation accelerate like there's no tomorrow. As the dollar dives, your cost of living could soar, and the price you pay for the food and fuel you need could potentially skyrocket. For folks on fixed income, this is the worst situation imaginable, caught between a rock and a hard place, hopelessly trapped between declining income and rising cost of living. So how much money could you make if you make the right moves? Well, as we've already seen, in just the last few weeks, a few very tiny, minuscule fissures in the massive bubble have opened. And one very liquid, easy-to-buy, leveraged investment has already risen in value by 75% in just 38 days. Another leveraged investment surged 141% in just 21 days. And a third soared 156% in value in a mere 22 days. That's enough to turn a $10,000 investment into $25,600 in less than 1 month. As this crash accelerates in the days ahead, your profits could be far greater over time. Plus, history offers some important clues to how large this crash and interest rate explosion will be. Between 1979 and early 1981, the price of 30-year Treasury bonds fell from about 92 to 62, a 30% decline. Long-term Treasuries lost almost 1/3 of their value in just 8 months. Bond yields shot up from 8.9% to 12.6%. That kind of move today could spin off gains of up to 960% for aggressive investors who use a triple leveraged ETF. Then, in 1994, bonds tanked from around 122 to 96, a 21% decline. Rates surged from 5.9% to 8.13%. Again, that kind of move today could spin off gains of up to 560% for aggressive investors using a leveraged ETF. And between December of 2008 and 2009, Treasury bonds plunged 30% and interest rates almost doubled. If you had seen that decline coming and harnessed its power with a handful of highly liquid investments anybody can buy, you could have walked away with a gain of up to 694%. But remember, we have never seen a bond market bubble that even comes close to what we have today. Bond prices have never been more inflated, and interest rates have never been this ridiculously low. So this time, all bets are off as to how high and how quickly interest rates could explode. But we do know one thing for sure. Interest rates cannot decline any further. They are effectively at zero. There's only one direction they can go from here, and that's up. I think we could see interest rates rise by at least the same amount as they did in those previous declines, and probably more. So what should you be doing right now to protect your wealth and profit as this great crash begins to unfold? What should you sell immediately to protect your wealth? What should you be buying right now to harness the awesome money-making potential as this unprecedented bubble begins to burst? My recommendation, if you believe this makes sense to you, then you should do exactly the same things with your money that I'm doing with the $1 million that Dr. Weiss has asked me to invest for him in our $1 million Contrarian portfolio. And that you also should consider the swing for the fences trades I'm about to make with the extra $25,000 Dr. Weiss just entrusted to me. I've prepared a complete report with all the details, and we'll take you there now.